Hey, this is Matthew from Commercial Deal Junkie, and I'm going to be going over qualifying for commercial loans. Commercial loans are actually quite different than residential loans. So many times people are talking to me about how exactly they can get qualified for this loan. I thought I'd take the time, make a video, and go over how to qualify for commercial loans. For some background, I'm a commercial real estate investor. I purchase commercial property all around the country, mostly retail centers, some apartment buildings all over, and I qualify for refinances and commercial purchases all the time. So I'm going to share what that process looks like as well as go over some examples. So how exactly are commercial loans different than residential loans? Number one, you probably hear this a lot. Commercial loans are more focused on the property than they are on the borrower. In residential loans, all they care about is your ability to make the mortgage payment every month. With commercial loans, they're looking at the ability of the property to make the commercial payments every month. That's why you hear a lot about debt service coverage ratio requirements. How much money is the property bringing in versus how much are they going to have to pay out? So they're even though they will look at your details, they will want to see your tax returns, they will want to see your personal financial statement. Their priority is the property, and that's what they're going to be looking at. Based on how well the property is performing, that's going to dictate the terms, how much interest rate you're going to get, how long of a loan they're going to give you. So even if you're a strong borrower, borrowing on a poor property, you're going to get, worse terms than a very high performing property. And one of the biggest difference I believe personally between commercial and residential lending is that commercial lending is relationship based. You can just because you have a good relationship with the bank, maybe you have deposits, maybe you had loans with them in the past, they will give you better rates than if you coming out of the blue and applying for a loan with them, which is something you don't really see in residential, where I could go up and I've already done, and this happened to me. I had two loans with a bank and I was coming to do a third loan on a commercial strip center in Wichita. Now I live in California, but they had seen that I set up auto pay on my loans. I have deposits with them, which is just a fancy way of saying money on in the bank account with them. So they came, and then was able to negotiate a quarter point discount. That's another thing about commercial loans is you can negotiate the terms. You can go in and say you submit all the information. They're going to give you terms, pretty much saying what interest rate we can give you, what amortization we can give you, and then you can go in and actually negotiate those down, which is not something I believe you can do in residential. I think you apply for the details and they're like, this is what it is. If you don't like it, go to another lender. And then this is something I want to focus on here. And I actually had something pulled up that I wanted to go over. So in commercial loan, you have term and you have amortization. Okay. So amortization is essentially over what period of time are you making the payments back over, or what is over how many years is the monthly payment calculated over? But it's not like residential where it's a 30-year loan. No, the loans have a shorter term in which at the end of the term, the loan needs to be either refinanced, the building needs to be sold, or in many cases, the rate for the loan is only locked in for the term. So some lenders will say it's a 5-year term where we'll lock in the rate, and then after that, it's variable. It means it's going to go up and down with the market. But your monthly payment is calculated over a 25-year payoff. So within 5 years, you have to either refinance, sell, or some lenders will keep you on and move you into a variable rate after the first 5 years. And then it's a 25-year payoff period that if you were to hold this loan for 25 years, by the end of year 25, you will have a zero balance on the loan. Now, some loans are interest only where there is no amortization. So it'll be a 5-year term, but you're only paying interest on the loan and the balance, your loan balance stays exactly the same. That's something that's quite different from the residential loans is that usually the amortization and the term are the same for residential. When you go out and you buy a house, it's a 30-year term and a 30-year amortization. Okay, but they don't even mention the two terms because they're the same. But in commercial, you got to keep in mind that in 5 years, you have to do some kind of capital event. In most cases, you have to do a capital event with the property. Now, you can get the term extended, and the lender will charge you for extending the term. Some lenders will let you go variable after, but you got to be very clear about this. A lot of commercial property owners get in trouble with this term situation. Well, they'll have vacancy come up before the end of the term, and then they're coming to do a refinance or sell the property, but it's not in good shape because there's vacancy. That's something really important to remember. And at the end of the day, each loan is different. Every lender does things their own way. They each have their own way they like to see things. Some like to have prepayment penalties, which is saying if you refinance the loan early, we're going to charge you a fee. Some don't. Some like to do long amortization. Some like to do interest only. And a lot of it depends on the property. So if you have a more stabilized property, you're going to get more stable loan terms, lower interest rate, longer amortization, longer term. If you have a non-stabilized property, like I'm purchasing a vacant retail center here, I'm going to be purchasing with what's commonly referred to as hard money, which is going to be a 24-month term, only 2 years on the term, interest only. And I have to, within 2 years, stabilize that loan and refinance the property. So every loan is different. Every commercial lender, there's different types of commercial lenders. I actually have a video where I go over the different kinds of commercial lenders. I'll put it somewhere in this video here so that you can see it. But you want to find the one that we can get the best terms for your property type. You're not going to come in with a property that's not stabilized and try to get extremely stabilized terms. So it really depends on the property. So what are the requirements for qualifying for commercial loans? Now, these are the typical requirements. Now, like I said, every loan is different. So some lenders are not gonna need this. Most lenders will need something close to this. And you could bring someone onto the team to qualify for the loan. So what you could do is, oh, I found a property but I don't qualify for the loan because of these requirements we're about to go over in a second. So what you could do is bring someone on the team, partner with them, and all they have to do is guarantee the loan. You can pay them an equity percentage. Okay. And there's also something I also forgot to put in here that I think is really, really important is recourse versus non-recourse. So some commercial loans, believe it or not, are non-recourse. Means that if the things were to go very, very poorly, you can literally take the keys and hand them right back to the lender and say, "Hey, this property is yours now," and you get to walk away. Now, why would lenders do that? Lenders typically do that on safer loans or large loan amounts where they believe that the property will be worth more than the loan amount. But especially when you're first getting started, loan values under 1 million, it's going to be recourse. Means that like all residential loans, that the lender can go after you if you default on the loan. So that's very important. So now requirements. So one of the requirements you see is that the lenders typically want to see your net worth to be greater than or equal to the loan amount. So if you're buying a $4 million property, you're putting $1 million down, you're raising $1 million, whatever, you're taking a $3 million loan, they want to see that the loan guarantor or the loan sponsor, so either you or someone you bring on your team, has a net worth over the loan amount, in this case, $3 million. They also have a liquidity requirement. So, I mean, some lenders do, some lenders don't. I've had lenders that wanted evidence of liquidity post closing. I've had many of them have not asked me, but some of them want to see anywhere from 5 to 15 to 20% liquidity after the purchase of the loan amount. So back to this $3 million example, $4 million property, $1 million down, $3 million loan, they'll want to see anywhere from 300,000 to 600,000 in cash or in easily accessible stocks and bonds after closing, after you pay that down payment. And then the last thing they want to see is a clean credit. Now, where they draw the line at the credit score is completely different between lender to lender. There's no number I can give you, but the higher the credit score, the better terms you're going to get. So if you're running, a mid high 700s, you'll get, better interest rate, longer term. Maybe they'll be less stringent on the liquidity if you have good interest rate. The conversation just tends to go a lot smoother when you have clean credit, no bankruptcies, and a strong credit score. So what kind of documents do they need? Before I go into this, these are just the ones that every lender I've worked with has needed for the most part. But just to show you, this is right here is the docs that was requested to me by credit union. They tend to be more strict on lending, so they have a lot of docs. These are all the documents they need. They wanted identification. They wanted a personal financial statement, which we'll go to in a second. They wanted business financial formation and documents. And I mean, they're lending you a lot of money. Commercial loans tend to be bigger than residential. So like they're typically lending you 6, 7 figures here. So they want to make sure they're covered. And then so let's go over some of this. So they want a personal financial statement, commonly referred to as a PFS. This is a document that goes over how much you have in cash, how much other real estate you have, how much you have in personal assets like cars and gold and jewelry. They're essentially, this is your net worth. This is how they figure out your net worth. And here's the thing, between me and you and the wall, they don't actually verify a lot of things on the personal financial statement. But because the point of the reason I'm saying that is that many people exaggerate the value of their assets. Because what they'll do is like, oh yeah, I own a property.
I have $400,000 in debt on it, and I think it's worth 1 million because you still own the property. So that 600,000 of equity there is unrealized. Some people will say, that property is worth 1.2. That property is worth 1.5. Some lenders will go in and verify the line items you have on the personal financial statement. Some of them will just go in and grab the net worth line. So some people exaggerate, and usually, you're not going to get in too much trouble if you exaggerate. Now, if you blatantly lie on this, chances are you will be caught. But some people go in and put their net worth in the best light by, exaggerating the value of their current assets. So, because that's what contribute typically the highest contribution to your net worth is the value of the assets minus the debt that's on the assets, that equity there. You also have a schedule of real estate owned. This is a document that goes over. Some of these lenders will give you templates, like here, right here, they have personal financial statement. This lender gave me a template. This is what they want to see. How much cash do you have on hand? How much in savings account? How much in real estate? So this is the personal financial statement that was given to me by Suncoast Credit Union. And as you can see here, you have to go into all your different debts, how much life insurance policy you have, how much stocks and bonds you have, what kind of real estate do you have. You dive into each one of those. Those are the things they want to see. And here's the schedule of real estate owned. What's the property owned under? What's the address? What kind of property is it? How much are you making from the property? What's the rental income from the property? So they want to get a global idea of what your situation looks like. That's for these two right here. They want to see what your personal situation looks like and then what your schedule of real estate looks like. I also want to see bank statements verifying liquidity in many cases where, what liquidity you have on your personal financial statement or the liquidity for the requirements. They'll want to see bank statements showing that liquidity. And then they'll also, in many cases, want to see tax returns. So they want to see, okay, what did you report to the IRS for the last few months about your income and your situation? Tax returns, maybe most of them last 2 years. Some of them will want to see 3. Okay. Next, many of them want to see a track record. Now, they can get that from the scheduled real estate owned. Some of them will take that. But in many cases, they'll just want a letter, commonly referred to as an LOE or a letter of explanation. And they want to know what your plan is with this property, or if there's any marks on your credit. They want to know exactly, oh, why do you have $60,000 in a balance on this credit card? What's the plan here? Why do you have this? What's the plan with this property? This one is the term is coming up soon. Are you going to refinance or are you going to sell it? What are you going to do with the money? So in many cases, you'll see quite a few LOEs, letters of explanations that they'll require from the lender. And typically this is after you submit all your docs, come in and ask for the letters of explanation. And this is pretty new to me. At the beginning, I didn't really run into this, but as the loan amounts got bigger, I've had lenders ask me for referrals from other lenders. They'll even give me a document. Like let's say I tell them, in my scheduled real estate owned, I'll say I have 2 loans with River Valley Credit Union in Ohio, where I own my apartment buildings. And they'll want to see, we want a letter from River Valley Credit Union that says your loans with them are in good standing. So I have to go to my loan officer, send them the document, and then they'll say, yes, Matthew's loans with River Valley Credit Union are in good standing. He's been with us for this long, et cetera, et cetera. Next to the property documents, they want 12 to 24 months of profit and loss on the property level. Now, sometimes this can be tricky, if the property is vacant or if you're buying from an unsophisticated seller that hasn't been keeping P&Ls. Sometimes this can be tricky, but something I'm going to go over at the end is the less documentation you submit, it's not like the loan's going to get declined, but you're probably going to get worse and worse terms the less you can submit to them. Some of these are non-negotiables, but some of them, it's like if you're unable to provide something, they're just going to increase the interest rate and decrease the term and decrease the amortization. So what they're trying to do is they're trying to put themselves in a safer position. They're assessing you as a risk. They want to see the 12 to 24 month profit and loss. They want to see the leases, and if it's a purchase, they want to see the purchase agreement, or if it's a refi. Then at the end of the day, commercial loans, they're quite different than the residential ones. A lot of it has to do with your relationship with the bank, and a lot of it has to do with the current situation of the asset. But the great thing about it is you can partner with people to help you get through these checklists. And it seems like a lot, especially when you're looking right here. I mean, it's a lot that they're asking for. Some of these are optional. This is if applicable. Now, this loan, I wasn't doing a construction, so I didn't need any of this. But it's a lot Now you want to stay organized, especially if you're doing a lot of commercial deals. If you create folders and systems and structures where you keep all your tax returns in one place, you keep all the information about the entity and all that in one place. They start reviewing it and start underwriting you as a borrower. So that's the gist of commercial lending. Like I said, every lender will be different. You have to reach out to them, have them send you a list of all the stuff they want, and then you just start filling it out one by one by one. Anyway, I hope you guys enjoyed the video on commercial lending. Join us in the school community. That's where we dive deeper on properties and actually go over some of the numbers on deals. And you can ask questions on specifically how to handle situations. But other than that, I hope you guys enjoyed the video, and I'll catch you guys in the next one.